Hello, welcome. Time for a market update. Carson Miles, what you got? What's going on in the market?
Let's do it. Thanks everybody for joining us today. I know we just did one probably 6 weeks ago,
Yep.
a month ago or so. And there's been obviously lots of stuff in the market and the economy going on. So we figured we'd be a little bit more proactive and hop back on here again just to see some stuff that we're seeing, stuff that we're hearing about, and also walk through what the stock market is doing. So
How the year turns out, but it's headed in that direction.
that's right. So then again, continuing on that same conversation, we love coming back to this chart. And this just depicts on the left side. There's two different charts here. On the left side, we see all the up and all the down, 100% capture of both up and down markets of the S&P 500 since, let's see, this is since right before the financial crisis in 2007. And then on the right, it's 80% of the up capture and 80% of the down capture. So you're not going to win as much in the up years, but you're also going to protect a little bit more whenever the market's going down. What happens here is you end up at the exact same place, making slightly more money 18 years later by having 80% of the up capture and 80% of the down capture. So you'll see, like, for example, take after 2009 up until 2020, you're going to have 100% less upside. So that seems like a massive amount to miss out 100% of the upside. But just by protecting 20% on the downside, you end up making up all the ground by not having as much upside participation. So it's not as fun to not win as much, but by just protecting enough whenever the market's going down, that makes up all the difference and gives you a smoother ride.
Well, in
Yeah,
simple math, if you lose 50% one year, you have to make 100% return to break even. So if you're down 20%, maybe you only have to make 28% or 30%. So the downside, a difference of being down 20 versus 30% is not just 10%. It's really compounded. And that's what average returns don't tell people. I won't nerd out and get in the weeds about compounded returns, but this chart shows that. And it even becomes more important when people, like, throughout the course of life in financial planning, we have clients you're pulling out money to live on. So this is assuming you're not even pulling out money, but if you start distributing your money, it becomes even more important that you're not pulling out money and losing a lot of money in a down year. So the kind of taking the edges off really does matter on the up and the down. Miles.
I think it makes most people a better investor if you can be down just a little bit less. You don't have to make as much in those up years. I mean, if you can be down, like we always say, if the market's down, or if we can be down half about what the market is, I mean, that's a much better experience overall and way less of an emotional roller coaster than feeling all the downside of the market.
Right.
Mm-hmm. We've had a lot of talk about recession probability, and I think the last thing that we've heard, well, in Q1 of this year, there was technically a negative GDP print, and a recession is technically two negative quarters of GDP growth. So going back to 2020, that was the last recession that we had, and it was a technical recession, even though it was the shortest recession we've ever had, because we technically had 2 quarters of negative GDP growth, even though the stock market finished positive in 2020 and in 2021. So what this graph is showing is that in times of recessions, it doesn't necessarily mean that all investments are going to stop working and everything's just going to go down. Look at your average US bond performance, 8%, averaging almost 8% rate of return during a recession. So during those headlines when unemployment's going up and put it in today's talks, there's talks of tariffs and how it's going to impact the United States economy, all these negative headlines. And look what asset class performs the best. You're averaging 8% historically across historical recessions for the United States. So just goes to show that, again, diversification, and just because there might be a recession on the horizon, maybe for the US, it doesn't necessarily mean that everything's going to be broken.
And I think I would say one of the big things is, like, I think people hear recession and they're like, oh my gosh, my portfolio is going to be down 25%. It's like, I mean, stocks are still on average up 1%. It's not great, but you're not down, 25, 30%, like he's even more than that than you saw during the Great Recession 2008.
Part of it too, we had, the last 10 years or so, bonds and CDs and stuff were paying nothing, like 1-2%. So it became, unpalatable for people to own bonds because, like, why do I want to put, X amount of money sitting in bonds doing 2% when I could have it in the market? But now it's a more compelling story to get people to say, okay, I understand the importance of bonds when they're paying 4, 5, 6, 7%, 8%, whatever. And they're actually an asset class that is producing and getting close to keeping up with inflation. So the story of diversification is getting easier now, like I said, because bonds are paying more and because you're actually seeing some asset classes like international and stuff start to actually perform. So, yeah, so it's still true that diversification works, even though it's been had people scratching their heads, I think, the last 5 years.
This is kind of an interesting chart here, but when you see all the white gaps, that indicates a recession, and all the purple are non-recessionary times. I think, and this goes back, I think, until 1953, 1955, or 1853. I'm sorry. So closing in on 200 years here, but recessions perfectly normal in the span of the United States history. Used to happen a lot more frequently, but even historically, roughly every 7-8 years, we're getting a recession. So recessions are, I hate to say it, normal. They're a thing that you can come to expect in the United States economy. But just reflecting on the last slide, it doesn't mean that things are just gonna be broken. And even during that time, I love this slide because it depicts that when things are the worst, the market is already on its way back up. You'll see on this left side, it talks about the S&P 500 back in 2020 and comparing it to the earnings cycle in 2020. The low of earnings per share bottom was in early 2021. Look how far the market had already recovered whenever the worst of earnings per share growth were already there. Same thing on real GDP. Look at where real GDP bottomed. The market was already well on its road to recovery. So it just goes to show that just because the market's down, or just because there's really, really, really negative and bad headlines, they're not always perfectly in sync with the stock market.
And goes to show just why it's so hard to time things. I mean, if you're trying to find the perfect bottom and you're watching company earnings, I mean, as you said, Carson, the market's so far ahead of itself. I mean, it usually trades about 6 to 9 months ahead of where it's at. And so, again, I mean, some of the losses that we saw previously here were probably priced in 6 months ago. And then the market's been able to snap back and recover from the lows that we saw earlier this year.
Yeah, like they could announce in 2 weeks that we've been in a recession for the last 3 months, and then that we could get a deal. Trump could get a deal with China on the tariffs, and the market could go hit all-time new highs. But we could technically still be coming out of a recession during the new highs, and the low of the recession was actually in the rearview mirror by the time they announce it. It happens all the time.
Yep. Really, just quickly on earnings per share growth, what ultimately drives the stock market higher, like Miles said, is it's pricing in 6 to 9 months in advance. But really, it's earnings per share growth. And at the end of the day, a stock price moves higher because it's the company is making more money. Currently, this is showing year over year quarterly earnings per share growth in the S&P 500. Q1, we hit 10% growth year over year in earnings per share. So that's where you get valuations on the S&P, whether it's on the multiple side or if the earnings per share is actually growing. And we're still getting great growth out of earnings per share in the S&P 500. Companies are still growing. Companies are making more money. Therefore, the stock market ends up trading higher.
Yep.
So pivoting just a little bit, that was a little bit about the market. Fed funds rate, here's where we're at currently. This is the last 10 years of Fed funds rate, and we're still much higher than what we have been historically. We're still at 4.25 on the lower limit of the Fed funds rate. They decided yesterday they're going to hold rates steady. So now everyone is questioning, when is the Fed going to raise interest rate? I think we all know, based on Trump's tweets, that he's throwing out that he wants Powell to lower rates. Whether or not he should, that's a conversation for another day.
I think he called him an idiot today. So.
Yeah. What's new? So, interest rates, the Fed is trying to keep in balance inflation and unemployment, and they're not necessarily focused or worried about tariffs. They just put themselves in a silo, look at the global or the U.S. macroeconomy and say, based on inflation and unemployment, where are we at? How should we hold Fed funds? And it's impossible to predict because it's all based on new economic development. So currently, like, had we talked about this 18 months ago, everybody would have expected interest rates to be cut to 3% by now. But times have changed, and the Fed decides what their Fed funds rate is going to be based on new data that comes out on a monthly basis. And right now, we might get a couple more cuts this year, maybe. Just depends on the economic data that comes out the rest of this year. But it's impossible to forecast. And generally, it's going to take another year, or at least another year before we see the Fed funds rate down to 3%. But again, it's impossible to predict. And even on that, estimated rates for mortgages, I think anybody who has a mortgage around 3%, I always say, print off your statement, frame it, because I don't know that you're ever going to see a 3% mortgage rate again. Or if you do, it's because bad things happened in the economy. And even mortgage rate expectations through 2027 are still in the mid sixes for the 30-year mortgage rate. So don't take that into account if you're going to be looking into a home, purchasing a home, that you can't just buy it now and always refinance later. There are some things you can do to get rates down a little bit. But higher rates are really not going away anytime soon.
Yeah. And I think the long-term average is like around what, it's pretty much where we're at right now, the historical long-term average.
6.5% or something.
Yeah. So it's like, and again, there's some big percentages of numbers in there, but to Carson's point, I think they're probably here to stay higher for a little bit longer.
Yeah, I think you're right, David, on mortgages, that long-term average is around that 6.5%. This chart shows the long-term average of the effective Fed funds rate, and mortgages are always
it was
above
zero
that.
for like 2010, almost 2020. It was essentially zero.
Mm-hmm.
That won't or should never happen again unless we're literally just printing off money and sending ourselves into $80 trillion of debt. So to Carson's point, it wouldn't be a great thing if mortgages were 3% again. We'd have bigger problems.
That's right. Yep. And where rates are at now, it feels high because we have recency bias and the fact that rates were so low for so long. But we are literally right in the long-term average over the past 70 years. We're perfectly in line. And it's kind of at a healthy point. But bigger issue, another conversation, is the government debt. They need rates to come down because we've got so much debt. But moving on from the rate conversation, Miles, you want to tackle this one?
Yeah, I really like this slide just because it shows, when there's huge market sell-offs, in this case, all of them 20% plus, some of you more than that. It's like, where's the market go from here? And I think that really starts to concern people. But in every time period here, 1 year out from a major sell-off, 5 years out, 10 years out, the market is significantly higher in a big way. So it just goes to show, again, why we always talk about it's more about your financial plan and making things are balanced and the time in the market rather than trying to timing the market, and the importance of that. Because when there is market sell-offs, historically, every time they have just been temporary, and you've seen pretty big comebacks in the market over all time periods.
Yeah. And let's talk about the tariffs during April. That was an emotional time for everyone. I think watching the stock market have those big down days, even for us, the conversations we're having, and look where we're at. I think since April 2nd, Liberation Day that Trump calls it, I think we're back to positive performance or right next to it. So it's very easy to get caught in the emotion of the stock market swings, but this just goes to show you're almost always going to be better off not getting caught up in the emotion of it.
Yeah.
Which is hard to do. Easier said than done.
Yeah.
Especially with program trading and institutional trading, you don't want to get caught in that crossfire of institutional, investing and day trading and that sort of thing. So the retail investor usually gets beat up pretty bad trying to play that game. So we coach our clients through that, and they're pretty good about that. Yeah.
And this slide here just shows the power of putting cash to work on the sidelines when there is market pullback. So, this is showing, if you started with $10,000 in 1980 through 2024, anytime there was a market pullback, if you added $1,000, $2,000, or $3,000, just how much that affected your performance. I don't think it says how many times that happened or how many times cash was added here, but it is anytime there was an 8% pullback. And so that's why we always say, if we see a 10% pullback in the market, don't try and time it perfectly. Could the market go lower from there? Of course it could, but that 10% range is kind of the key we look to when clients have cash on the sidelines to really start adding it in a big way. And then, versus taking $1,000 or $2,000 or $3,000 out, you end up with 7 times more money, which is, it's insane to see these numbers, but it just shows the importance of trying to add money, even in a small way. Maybe you think, adding $2,000, that's not really going to affect me in the long term. It has a huge impact, versus just taking a couple thousand out.
So the systematic, I tell people, like, taking the emotion out of it and trying to become almost like robot-like when you're doing investing and following the principles of dollar cost averaging every month, and then saying, but if there's ever a 5 or 10% drop, we add extra money, and then never going to cash when the market's down. Basically what this chart says, this just kind of quantifies and shows the power of what we explain to clients every day. If you can just take that headache, but honestly, by taking the stress on and trying to predict it yourself, you just get more stressed out, and 90% of the time you make worse decisions and your long-term returns are way off. And so just having that process, makes a huge difference.
That's right. Just a couple more just about the corrections and drawdowns, and then we'll wrap it up and see if we have any questions. But returns after a 15% drawdown, 1 year later, the average is about 15%, 3 years later, 40%, 5 years later, 66, and 10 years later, 185%. And 100% of the time, those returns are positive. So if you're a long-term investor and we have a 15% correction or worse, per this chart, historically, 100% of the time, 10 years later, you're going to have a great and very, very positive rate of return. You even have an 83% chance that 1 year later, you're going to make 15% on overall performance. So just like you said, David, take the guesswork out of it. Market's down 10%, market's down 15%. Throw some cash at it. Odds are in your favor that it's going to be a good investment. Doesn't mean that it could go down a little bit more, but odds are in your favor.
Yeah, play the odds. I mean, especially when they're this much in your favor. I mean, Vegas was built off of 51%, 1% in their favor. So I would definitely play these odds.
Exactly. Think about it that way. Think about if, you've got an 83% chance to win at a hand in Vegas, you're going to take that all day. Absolutely all day. So when you think about it that way, that's good. And then lastly, just historically, we've had 32 10 to 20% corrections since 1940, which means they happen, but they don't happen every year. So for the long-term investor, I think it's a great view that whenever they come, take advantage of it, because they don't come every year. They might not ever come every couple of years, but they do come relatively frequently, especially in the 10 to 20% range. So definitely take advantage and know that that long-term rate of return, by throwing some cash at it, you're going to benefit from it.
Yeah. I mean, this is over like what, an 84, 85 year period. And there's what, 40, quick math, 46
about every other
corrections of, so about half the time the market's down more than 10%.
Yeah.
So it's like, again, just comes back to volatility of greater than 10% corrections being a very normal part of investing.
That's good.
The only reason people struggle with this is it's easy to look at this and say, yeah, but this time is different. And it always does feel different. Every single president, every single war, every single new thing that comes up, it always does seem different. But knock on wood, so far it hasn't been. And it's just not in your, it doesn't behoove you to try to fight the odds. And I'll just tell you quickly, take questions at the bottom. If you want to ask a question, you can. I was just in Montreal at a global top advisor summit and had some, big economists there. And one of them was Raymond James, chief economist. But basically the question was, are we going to have a recession? And 50-50 odds. And then Carson and Miles today, we're looking at other institutional shops that were saying 50-50, meaning tells us absolutely nothing, but meaning one thing they said was, look, 4 of the 5 big indicators, things like auto sales and different things like that, were very positive before tariffs were implemented. So it's likely that we barely avoid a recession, which feels like maybe we're going to do now, but we still don't know. So I'm not saying that necessarily, but that was kind of their base case, is 50% chance, but probably going to just barely avoid it. And then also there's just some intangible things. When you think about politics, I mean, all the, whether it's Trump in his last term and just people like with their legacies and midterms coming up, and also the 250th celebration of the USA, all these things coming up. Nobody wants to have a recession coming up during the midterms or their legacy year or during our big birthday. So there's a lot of forces at play that would say, they're working really hard to get deals done and things like that. Just kind of the human factor there I wanted to point out. And then the other thing I had asked was, seeing international stocks outperforming this year, what's your asset class big winner over 3, 5, and 10 years? And they all said the U.S. equity markets. They still believe that the U.S. is the prettiest house on an ugly block and will outperform bonds and international stocks and all that. But that you need to stay diversified, but heavier, like more tilted towards U.S., which we are. We have a little bit of international, a healthy dose, but we stay overweighted to US. And so it looks like we'll continue to do that. But all those things are just predictions. And when I hear 50-50, it means nobody knows. So do we have any questions? I don't see any.
Yeah, I don't see any today. But doesn't mean you can't ask them. Feel free to always follow up with David, Miles, and myself if you have any questions or if there's anything else we can help with. We're always going to, stay proactive, sending things out via email, make sure that all of our clients know exactly what we're thinking, what we're hearing, and also how we're going to deploy that into client portfolios and what we're managing here. But yeah, I think this was good to go over a few things, and we'll definitely keep everybody at the top of mind as we hear more about tariffs and as more news came out. I think Trump struck a deal with the UK today, and so that's positive news on the tariff headlines, and we'll see what else is yet to come.
Got a question or a comment? Congrats on another award, Best Workplace. Thank you very much for saying that. That's honestly one of the awards that I, as founder, am most proud of is Best Workplace, having a team that enjoys being here and good culture. Thanks for that. And then who's the new Pope?
The new Pope,
first American Pope.
Yeah. It is an American guy.
Robert Prevost.
Robert Prevost.
There you go.
There you go. All right.
Answered.
Thanks, everybody. We will send out, like Carson said, we'll send out a replay of this. And again, sometimes this stuff gets a little mundane and boring, but we think it's very important to be proactive and stay ahead of this. And education is power and key. So thanks for joining us. We'll talk soon.